Ladies and gentlemen, most people think the biggest risk today is inflation. Others think it's recession. I think they're looking at the wrong problem. The real issue is that we're reaching the end of a debt cycle that's been building for decades. Governments are borrowing more, interest costs are rising, and confidence in paper assets is being tested. History shows that when debt reaches unsustainable levels, money flows toward real assets. The question isn't whether the financial system faces pressure, it's where capital goes next. And that's why silver deserves serious attention. The financial system has always operated in cycles. Periods of stability encourage confidence, confidence encourages borrowing, and borrowing fuels economic growth. For a while, that formula works remarkably well. Businesses expand, consumers spend, governments invest, and financial markets reward optimism. The problem begins when debt grows faster than the economy's ability to support it. At first, the imbalance is difficult to notice because low interest rates keep borrowing costs manageable. Money appears abundant, credit is easily available, and the risks seem distant. But debt never disappears. It simply accumulates, quietly building beneath the surface until the cost of carrying it begins to outweigh the benefits it once created. Today, one of the biggest challenges facing the global economy is not simply the size of debt, but the speed at which it has expanded over many years. Governments have relied heavily on borrowing to finance spending. Corporations have taken advantage of inexpensive financing to buy back shares, acquire competitors, and expand operations. Consumers have also become increasingly dependent on credit to maintain spending. Each sector has made decisions that were rational in an environment where borrowing was inexpensive. The problem is that the economic environment has changed. When interest rates remain low for an extended period, markets begin to assume they will stay low indefinitely. Investors become comfortable taking greater risks because financing is cheap. Asset prices rise, leverage increases, and optimism becomes deeply embedded in financial decision-making. But markets have a way of reminding participants that conditions do not remain favorable forever. When inflation emerges and central banks raise interest rates to restore price stability, the entire equation changes. Suddenly, debt that once looked manageable becomes significantly more expensive. The first warning signs rarely appear as dramatic headlines. They emerge gradually. Governments begin allocating larger portions of their budgets to interest payments rather than productive investments. Companies refinance debt at much higher costs, reducing profits and limiting future expansion. Consumers facing higher mortgage rates, credit card interest, and loan payments become more cautious with spending. Economic momentum begins to slow, not because people suddenly lose confidence, but because servicing existing obligations consumes a growing share of available income. This is how debt cycles evolve. They are rarely destroyed by one single event. Instead, pressure builds over time. Every increase in borrowing costs reduces flexibility. Every refinancing decision becomes more difficult. Every economic slowdown exposes weaknesses that remained hidden during years of easy money. Financial markets, which often look forward rather than backward, begin adjusting long before the broader economy fully recognizes the risks. Confidence is perhaps the most underestimated force in the financial system. Modern economies function because individuals, businesses, and investors believe tomorrow will be stable enough to honor today's commitments. Credit itself is built on trust. Lenders trust borrowers will repay. Investors trust governments will maintain sound financial policies. Businesses trust customers will continue spending. Once confidence begins to weaken, financial conditions can tighten much faster than many expect. History consistently demonstrates that excessive leverage increases vulnerability. High debt levels do not automatically create a crisis. Wealthy economies can sustain significant borrowing for extended periods if productivity, innovation, and economic growth remain strong. Problems arise when debt expands much faster than income, production, and long-term economic capacity. At that point, economies become increasingly dependent on continued borrowing simply to maintain existing levels of activity. That is not sustainable indefinitely. Another important factor is the growing cost of servicing accumulated debt. Rising interest expenses represent resources that cannot be invested elsewhere. Governments have less room for infrastructure, education, healthcare, and national development. Businesses reduce investments in research, technology, and hiring. Households delay major purchases because larger portions of income are devoted to existing financial obligations. The economy becomes less dynamic, not because opportunities disappear, but because financial flexibility becomes increasingly constrained. Financial markets are remarkably efficient at identifying these shifts. Investors constantly evaluate whether future economic growth will justify current asset valuations. If they believe debt burdens are becoming excessive, capital capital begins moving more cautiously. Risk premiums increase. Lending standards tighten. Liquidity becomes less abundant. These changes often reinforce each other, creating a cycle where tighter financial conditions further slow economic activity. None of this suggests that collapse is inevitable or that every debt cycle ends in crisis. Strong institutions, responsible fiscal management, technological innovation, and productivity growth can all help economies navigate challenging periods successfully. Markets have repeatedly demonstrated resilience over decades, adapting to changing conditions through reforms, innovation, and disciplined policymaking. However, resilience should never be confused with immunity. High debt levels reduce the margin for error, making economies more sensitive to unexpected shocks. The most successful investors and business leaders do not spend their time predicting dramatic outcomes. Instead, they focus on identifying risks before they become obvious. They understand that preserving capital during periods of uncertainty is often more valuable than chasing extraordinary returns during periods of excessive optimism. Disciplined risk management consistently outperforms emotional decision-making over the long term. What makes the current environment particularly important is the combination of elevated debt, higher borrowing costs, geopolitical uncertainty, and structural economic changes occurring simultaneously. None of these factors alone determines the future. Together, however, they create an environment where careful analysis matters more than ever. Investors should pay close attention not only to economic growth, but also to balance sheets, cash flows, interest expenses, and the sustainability of long-term financial commitments. Ultimately, debt is neither inherently good nor inherently bad. Used responsibly, it finances innovation, supports economic expansion, and improves living standards. Used excessively, it gradually limits flexibility, reduces resilience, and increases systemic risk. The challenge facing today's global economy is not simply managing existing debt, but ensuring future growth is built on productivity and investment rather than ever-increasing leverage. That distinction may determine how successfully economies navigate the years ahead. Markets have a tendency to move between extremes. During periods of confidence, investors often favor assets that promise growth, innovation, and higher returns. Capital flows toward equities, corporate expansion, and sectors expected to benefit from strong economic conditions. During periods of uncertainty, however, priorities begin to change. Investors become less focused on maximizing returns and more concerned with preserving purchasing power, protecting capital, and maintaining flexibility. It is during these transitions that precious metals often receive renewed attention, and silver occupies a unique position within that conversation. Unlike many assets, silver derives its importance from two distinct sources of demand. It has long been recognized as a monetary metal, valued for its ability to store wealth over long periods of time. At the same time, it is an essential industrial commodity used in a wide range of modern technologies. That combination makes silver different from most other investments. Its value is influenced not only by financial markets and investor sentiment, but also by manufacturing activity, technological innovation, and global industrial production. When uncertainty increases across financial markets, investors naturally begin asking whether traditional assets can continue delivering the same level of stability they have enjoyed in previous years. Stocks, bonds, and currencies all perform important roles within a diversified portfolio, but each is influenced by economic policy, interests, rates, and market expectations. Precious metals often enter the discussion because they represent tangible assets that cannot be created by policy decisions alone. Silver benefits whenever investors seek greater diversification during periods of heightened uncertainty. Another reason silver attracts attention is its relatively small market compared with many other global asset classes. The total value of the silver market is modest when compared with global equity markets, government bond markets, or even the market for gold. Because of its smaller size, changes in investment demand can have a proportionally larger impact on prices. If institutional investors, private wealth managers, or retail participants allocate even a small percentage of capital towards silver, the effect on market dynamics can be meaningful. Industrial demand also provides an important layer of support. Silver possesses exceptional electrical conductivity, thermal conductivity, and reflective properties that make it valuable in advanced manufacturing. It is used in electronics, medical equipment, automotive systems, solar technology, telecommunications, and numerous industrial applications. As economies continue investing in digital infrastructure, renewable energy, and advanced manufacturing, Industrial demand for silver has the potential to remain an important factor. This creates a situation where both investment demand and industrial consumption influence the same market simultaneously. Supply dynamics deserve equal attention. Expanding the production of any mined commodity is rarely a quick process. Discovering economically viable deposits, securing permits, financing projects, and constructing mining operations often requires many years. Existing mines naturally experience declining production over time as higher grade resources become depleted. Even when prices increase, additional supply cannot immediately reach the market. This means that periods of stronger demand may not always be matched by an equally rapid increase in production. Another important consideration is the relationship between silver and broader monetary conditions. Inflation affects purchasing power by reducing the value of money over time. When inflation remains elevated or when investors become uncertain about the long-term direction of monetary policy, hard assets often receive greater attention. Silver has historically been included among those assets because it represents a physical commodity with intrinsic industrial value rather than a financial promise issued by another institution. While historical performance does not guarantee future results, this characteristic continues to influence investor behavior during uncertain economic environments. Interest rates also play an important role. Higher interest rates generally increase the attractiveness of income-producing investments while reducing the appeal of assets that do not generate cash flow. However, markets rarely respond to one variable alone. Investors evaluate interest rates alongside inflation, economic growth, fiscal policy, and geopolitical developments. If concerns about financial stability or long-term purchasing power outweigh the benefits of higher yields, precious metals can still attract investment despite elevated interest rates. The interaction between these forces is often more important than any single economic indicator. Market psychology should never be underestimated. Financial markets are driven not only by data, but also by expectations. When investors collectively believe that risks are increasing, capital can move rapidly from one asset class to another. These shifts often occur before economic data fully reflects changing conditions. Expectations surrounding future inflation, government borrowing, central bank policy, or economic growth can influence investment decisions long before measurable outcomes appear. Silver frequently becomes part of these discussions because it sits at the intersection of financial markets and industrial demand. It is equally important to recognize that silver is not without risk. Price volatility has historically been greater than that of many traditional investments. Sharp advances have often been followed by equally significant corrections. Investors who approach the market expecting uninterrupted gains frequently underestimate how quickly sentiment can change. Successful long-term investing requires patience, diversification, and a willingness to evaluate fundamentals rather than react to short-term price movements. Rather than viewing silver as a speculative trade, many experienced investors consider it one component of a broader risk management strategy. Diversification remains one of the most effective tools available to reduce portfolio risk. Different asset classes perform well under different economic conditions, and no single investment consistently outperforms across every market environment. Including assets with different drivers of return can strengthen long-term resilience without requiring dramatic predictions about the future. Ultimately, the case for silver is not built on certainty, but on probability. It reflects the possibility that rising industrial demand, constrained supply, ongoing monetary uncertainty, and changing investor preferences could create favorable conditions over time. None of these factors guarantees higher prices, and markets are capable of surprising even the most experienced participants. What matters is understanding the balance of risks and opportunities rather than relying on bold forecasts. Investors who remain disciplined, focus on fundamentals, and maintain a long-term perspective are generally better positioned to navigate uncertainty than those who chase headlines or emotionally react to every market swing. In an increasingly complex global economy, silver remains an asset worth watching, not because extraordinary outcomes are guaranteed, but because its unique combination of industrial relevance and monetary history gives it a distinctive role within the broader financial landscape. One of the greatest mistakes investors make is confusing a compelling story with a sound investment. Markets are filled with narratives that promise extraordinary returns, dramatic breakthroughs, or inevitable outcomes. Every cycle has them. Sometimes those stories prove accurate, but more often they become exaggerated as enthusiasm grows. The discipline required to separate facts from emotion is one of the most valuable skills any investor can develop. Long-term success is rarely determined by finding the perfect investment. It is determined by consistently making thoughtful decisions while avoiding unnecessary risks. Financial markets reward patience far more often than they reward excitement. Prices move every day, headlines change every hour, and opinions shift with remarkable speed. Yet the underlying value of businesses, commodities, and assets changes much more gradually. Investors who react emotionally to every piece of news often find themselves buying after optimism has already pushed prices higher and selling after fear has already driven prices lower. This cycle repeats itself throughout history because human behavior changes far more slowly than technology or financial markets. Periods of uncertainty naturally create anxiety. Economic data may weaken, inflation may remain unpredictable, geopolitical tensions may increase, or financial markets may experience heightened volatility. During these moments, the temptation to make dramatic portfolio changes becomes stronger. Some investors rush toward whatever asset has recently performed well. Others move entirely into cash because uncertainty feels uncomfortable. Neither extreme is usually supported by disciplined analysis. Successful investing requires recognizing uncertainty without allowing it to dictate every decision. Risk is often misunderstood. Many people define risk as price volatility, but volatility and risk are not the same thing. Prices fluctuate constantly, sometimes for reasons unrelated to long-term fundamentals. Real risk comes from overpaying for an asset, concentrating too much capital in one position, relying on excessive leverage, or investing without understanding the factors that determine long-term value. Temporary market declines can be uncomfortable, but permanent loss of capital usually results from poor decisions rather than unpredictable markets. Diversification remains one of the simplest and most effective principles in finance. No investor consistently predicts every economic cycle correctly. Even experienced professionals acknowledge that forecasting markets with precision is extraordinarily difficult. Holding different types of assets helps reduce dependence on any single economic outcome. Some investments perform better during periods of strong economic growth, while others provide resilience during slower environments. The objective is not to eliminate risk entirely, that is impossible, but to avoid exposing a portfolio to unnecessary concentrations of risk. Discipline also means maintaining realistic expectations. Every market cycle produces predictions of extraordinary gains and catastrophic losses. Reality is usually more balanced. Markets experience expansions, corrections, recoveries, and occasional crises, but over long periods, they have consistently demonstrated resilience. Investors who expect every opportunity to produce immediate and exceptional returns often become disappointed. Those who understand that wealth is typically built gradually are more likely to remain patient when markets become challenging. Another important principle is maintaining adequate liquidity. Opportunities often appear during periods of market stress, but only investors with financial flexibility are able to take advantage of them. Individuals or institutions operating with excessive leverage may be forced to sell quality assets precisely when valuations become most attractive. Liquidity provides optionality. It allows investors to respond thoughtfully instead of reacting under pressure. Financial flexibility is often underestimated during prosperous periods and deeply appreciated during difficult ones. Emotional discipline becomes especially valuable when markets become highly polarized. Optimism can create the illusion that risks no longer matter, encouraging excessive borrowing and speculative behavior. Fear can create the opposite illusion, convincing investors that opportunities no longer exist even when valuations become increasingly attractive. Neither extreme reflects rational decision-making. Markets are driven by probabilities rather than certainties, and the most successful participants continuously reassess evidence instead of defending emotional convictions. It is also important to recognize the difference between investing and speculation. Investing involves evaluating long-term cash flows, productive assets, competitive advantages, and sustainable economic trends. Speculation often depends on predicting short-term price movements driven primarily by market sentiment. Both activities exist within financial markets, but confusing one for the other can lead to unrealistic expectations. Investors benefit from understanding exactly why they own an asset and what conditions would justify increasing, reducing, or maintaining that position. The broader economic environment will continue evolving, interest rates will change, inflation will fluctuate, technological innovation will reshape industries, and government policies will influence investment conditions. These developments create both risks and opportunities. Attempting to predict every short-term movement is unlikely to produce consistent success. Building a portfolio capable of performing reasonably well across multiple economic scenarios is often a more effective approach than attempting to anticipate every market turning point. Another characteristic shared by successful investors is intellectual humility. Markets have a remarkable ability to challenge widely accepted assumptions. Even carefully researched opinions can prove incorrect because unexpected events occur, new information emerges, and economic conditions evolve. Remaining open to changing one's perspective when evidence changes is a strength rather than a weakness. Confidence should be based on careful analysis, not on certainty about outcomes that no one can fully predict. Patience is frequently underestimated because it lacks excitement, yet compounding rewards those willing to think in years rather than weeks. Businesses grow gradually, innovation takes time, and economic progress rarely follows a perfectly straight line. Investors who allow quality assets sufficient time to realize their potential often benefit more than those constantly searching for the next dramatic opportunity. Long-term wealth creation is usually the result of consistent decision-making rather than extraordinary predictions. Ultimately, every investment decision should begin with a simple question. Does this position improve the overall resilience and long-term quality of the portfolio? If the answer depends entirely on optimistic assumptions or perfect economic conditions, caution is warranted. If the investment remains supported by sound fundamentals under a range of plausible scenarios, confidence becomes more justified. Markets will always experience uncertainty, and no strategy eliminates every risk. The objective is not perfection, but preparation. Investors who remain disciplined, diversify thoughtfully, preserve financial flexibility, and focus on long-term fundamentals are generally better positioned to navigate changing market conditions than those driven by fear or excitement. Opportunities will always emerge, but the ability to benefit from them depends less on predicting the future and more on maintaining the discipline to act rationally when others cannot.